Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We've just released our India Monthly Market Outlook titled Stay C.A.L.M, Allocate Broadly. In today's podcast, we summarize our macro and key asset class views. Before we get started, a quick roundup of the past month. The Nifty index closed flat but outperformed other peers like the MSCI Asia ex Japan, which fell 2.2%, and MSCI Developed Markets, which fell 0.4%. Broader markets continued to outperform large cap equities, with the Nifty mid cap up 7% and Nifty small cap up 8.2%. The 10-year Indian government bond yields rose 2 basis points to 7.2%, while the INR fell 0.2% against the USD. The pullback in equities and spike in bond yields is a reminder of the risk investors face after a strong rebound since April lows. The pendulum continues to oscillate between recession and Goldilocks for major developed economies. The two competing narratives, India's robust domestic macro fundamentals remains ahead of its major peers, versus high likelihood of a sharp growth slowdown in developed economies, is likely to remain the key driver for Indian assets, albeit increased near-term risk from higher oil prices and domestic inflationary pressures. Our calm framework is a prudent approach to navigate current market conditions. The letter A in this framework, which stands for allocate broadly, maintaining a diversified and balanced foundation allocation, remains significant during such periods of uncertainty to help manage volatility. Moving on to our macro views. On growth, we expect India's economic growth to track above its long-term trend and stay ahead of its major peers in the second half of 2023, with India's growth likely to be resilient to weakening global growth given supportive government policies, sustained revival in services, and a pickup in private capex. As per Bloomberg estimates, India's fiscal year 2024 GDP growth is likely to be around 6.1%, which remains above peers. In our assessment, fiscal policy is likely to be the key driver for growth in 2023 as financial conditions remain tighter than normal. The past measures undertaken by the government, which includes greater public capex spend, long-standing reforms related to taxation and labour, and providing incentives to boost manufacturing and infrastructure, is a likely boost for India's medium-term growth outlook. On inflation, we believe the consumer price inflation is likely to trend lower in 2023, tracking within the RBI's medium-term target range of 2% to 6%, given high base effect, easing commodity prices, and lagged impact of monetary policy. On key asset class views, we remain neutral on Indian equities as robust domestic growth and strong corporate earnings cycle is counterbalanced by stretched valuation premiums, both absolute and relative to peers. The Nifty index registered an earnings growth of 11% for fiscal year 2023, while the expectations for fiscal year 24 and 2025 are estimated at 19% and 17% respectively. Within equities, we are overweight mid-cap and small-cap equities given broad growth momentum, improving earnings outlook, wider industry representation, and a likely peak in bond yields. We have a preference for value-style equities. On sectors, we prefer a barbell strategy where we prefer domestic cyclicals and accordingly maintain an overweight on financials and industrials. We balance this by a defensive tilt in the portfolio through an overweight on healthcare. We maintain a neutral stance on bonds as we expect attractive absolute and real yields to be counterbalanced by below average yield premiums, stretched medium-term fiscal position, and weak government bond demand and supply balance. In our view, the RBI's decision to keep policy rates unchanged in its past 3 policy meetings, despite the recent surge in inflation prints, likely signals an end to the tightening cycle. We expect the 10-year Indian government bond yield to likely trade in the range of 6.75 to 7%. We see an opportunity to lock in attractive yields post the rise in the month of August, with a likely peak in bond yields given the RBI's pause on policy rates. We are overweight medium and long maturity bonds. We have a preference for corporate bonds which basically offer a yield premium over commensurate maturity government bonds, as in our view, they offer a better risk reward amid attractive spreads and improving corporate fundamentals. In addition, higher absolute bond yields and lower currency volatility provide a stable carry relative to other emerging market peers. However, 3 factors remain unfavorable for bonds. First, fiscal deficit is likely to remain high over the medium term. Second, worsening government bond supply balance given high supply of government bonds amid a lack of support from the RBI. Third, higher than expected inflation could keep bond yields elevated as the RBI maintains a prolonged pause on policy rates. Cash remains a neutral holding, and finally, gold remains a neutral holding and a portfolio hedge against elevated inflation and equity market volatility. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our market outlook. And thank you as always for listening. If you find this podcast useful, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.